Market Committee or the Fed Monetary Policy Entity. Congress does not direct day-to-day monetary policy, and Congress also does not direct generals on battlefields, nor should we. However, the GAO routinely conducts policy audits of the defense policy and strategy, yet the GAO is restricted from conducting policy audits on the Federal Reserve. I'm challenged to understand how policy audits of critical national defense strategy is okay, but policy audits of the Fed are off limits. The defense industry is surely at least as sensitive as the monetary policy. And I'd like your thoughts on that.
Sure. So the GAO does do policy audits on the Fed constantly all over the place at the Fed, just with one exception, and that is our specific monetary policy function. Congress chose long ago to create one step of distance away from the GAO in order to underline our independence. I think that was a wise move. I think changing that would clearly be seen by the public as a diminution of our independence. We do look to this committee and to the equivalent committee on the Senate side for oversight on monetary policy in our system of government. Our road to oversight and transparency runs right through this committee and the Senate Banking Committee as well. So anyway, that's what I would tell you about the GAO.
What do you think makes the Fed more immune to review than the defense? What's the rationale behind it, do you think?
Well, again, everything we do on payments and financial regulation, every single thing we do is subject to GAO audit. And these are policy audits. It's not like a financial audit. The public should understand that we are audited. Our business model is actually about as simple as that as a very small community bank. It's not complicated, and we're constantly audited. What this exemption does is it prevents the GAO from coming in and looking at and assessing individual monetary policy decisions, which Congress saw fit, you saw fit, your Congress saw fit, to carve out of the law. And I think it was an appropriate thing to do, and I think it would be unwise to take a step back from that. I don't see any harm that it's doing.
Well, the former chairpersons of the Fed have indicated they simply did not want to be second-guessed on their decisions, that the public really doesn't have a right to know. I find that illogical, quite frankly, and that's why I asked you these questions.
I mean, we're very transparent. We publish minutes. We publish transcripts.
I know. We publish
We're not
everything.
hiding anything.
We publish everything but, and I'm just, I think the but exemption is overdue.
The gentleman from Missouri, Mr. Clay, who is also the chair for the Subcommittee on Housing, Community Development, and Insurance, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for being here today. For most of the constituents in my congressional district, they are not focused on the Dow maintaining a 30,000 level, but simply trying to make ends meet. In fact, the St. Louis Fed, in an essay as part of its Demographics of Wealth series, examined the connection between race or ethnicity and wealth accumulation. Over the past quarter century, it was the result of an analysis of data collected between 1989 and 2013. Through the Federal Reserve Survey of Consumer Finances, more than 40,000 heads of households were interviewed over those years. Median Hispanic and Black wealth levels are about 90% lower than the median white wealth level, yet median income levels of Hispanics and Blacks are only 40% lower. The larger racial wealth gap could be due to Hispanics and Blacks investing in low-return assets like housing, as well as to borrowing at higher interest rates. Hispanics and Blacks could also feel less of a need to save for the future because society's progressive old age safety net programs will replace a relatively larger share of the normal incomes they earn during their working years. Could you comment on why many communities continue to lag and how the Fed, via its monetary policy, might seek to address some of the underlying factors that have led to gross inequality?
What we can do, and what we have been doing, is to take seriously your order to us to seek maximum employment. And that's what we're doing. I think we've just learned, because we've been watching what's been happening, that unemployment can be lower than many had expected without raising inflationary or other concerns. So that's what we can do, and we will continue to do. And I think that's showing up in communities everywhere. I think other governmental and other tools are necessary to address longer run problems, though.
Such as, how do we address the pay inequity? How do we impress upon corporate America that it does its country no good to have a persistent pay inequity among its workers, especially when you look at the disparities in the races and the pay inequity?
I will say I think it's important that those issues be addressed. It's really not for the Fed to prescribe the measures to address them. We need to stay in our lane. We do have this grant of independence, including the GAO exemption, and I think to keep that, we need to stay with what you've given us to do, which is maximum employment, stable prices, supervise the banks, look after financial sector.
And on another subject, will the Federal Reserve release its own proposal on the Community Reinvestment Act, one that takes into account the needs of low and moderate income communities?
We haven't made a decision on that yet. I think our focus right now is on the ongoing process of the other agencies' proposal and the comments. I think we're going to learn a lot from those comments, and I suspect there'll be changes to that proposal coming out of the comments. And you know, so we have not made a decision about our own proposal.
Well, traditional monetary policy works through a single economy-wide variable, a single interest rate, or perhaps the money supply or growth of credit. Credit policy, by contrast, aims at directing credit in specific forms towards specific groups of borrowers. Credit policy consists of a central bank operations targeting specific segments of the private debt and securities market. What is your view of shifting from traditional monetary theory to one that involves a use of more tools in order to enhance borrowing to segments of society?
So I think that has historically not been a function of the Fed and of central banks generally. We have, as you pointed out, one tool, which is our interest rate policy. When you're talking about affecting different sectors of the business community or of the population, that really should be another agency or Congress itself in fiscal policy rather than.
The witness is requested to continue to provide an answer in writing for the record.
Thank you.
The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Chairman Powell. Always good to see you, sir. I'm sure you saw the speech and probably read or heard the speech by Vice Chairman Quarles on the need to reform banking supervision. One area I think needs clarity in the supervision regime is the role of guidance. I pushed regulators to clarify the use of guidance, and in 2018 he came out with an interagency statement on guidance. However, Vice Chairman Quarles in his speech urged an additional step, doing a rulemaking of the role of guidance. This fits with Trump's administration recent actions out of the Office of Management and Budget. My question is, do you believe we need an official rulemaking out of the Fed on the role of guidance?
We have not made a decision on that. We're, like the other agencies, we're evaluating the OMB memo. As you know, guidance is not enforceable. It's not, and so we do understand that. Guidance is not a rule.
You know, Mr. Quarles was here recently, and I think he made the comment that he intended to look at all the guidance and separate out what he believed needed to be under rule, and the rest of it then be clarified.
Now, just so you guys are clear, what you're listening to is actually the monetary policy and state of the economy. This is actually being conducted live. Um, I want to make sure everybody understands exactly what's being done in real time. I don't want you to take my word for it. I want you to understand and know that this is real. It affects everyone. And if you do not take serious heed to the ability to substantiate your credit losses, what you're listening to is the monetary policy and the state of the economy of what they're going to do because of your lack of implementation. You're listening to a gentleman by the name of Chairman Powell. This is the Financial Services Committee. And all I'm going to say is that in this training, notaries have to be made very clear. The chairman of the Board of Governors of the Federal Reserve System, Jerome Powell, will testify on the conduct of the monetary policy and state of the economy. He will be the only witness. You got to understand that means your inability to move in commerce under the new accounting standards. I'm just going to give you some background. In the 1970s, the United States experienced an unusual combination of high inflation and unemployment referred to as stagflation. The Federal Reserve Reformation Act of 1977 was amended, which amended the Federal Reserve Act to pursue the goals of maximum employment, stable prices, and moderate long-term interest rates. Since moderate long-term interest rates remain low only in a stable price environment, these goals are generally thought of as a dual monetary policy mandate of maximum employment and price stability. In other words, if everything is all good just a week ago, then the actual growth that they're reporting should substantiate an ability to lend more because people can afford to pay back what they borrowed. But it has a set of numerical targets for maximum employment. Here's the problem. Currently at 2%, those 2% was based on inflated numbers. And because it was based on inflated numbers, you're no longer in Kansas anymore. Because CECL implementation has already structured the banks to bail themselves in, that means you're going to be forced out. They only meet twice a year. This month, which is February, and again in July. And you're going to see how the board handles the monetary policy and the observations of the economic development. And all I'm going to say is that you've been warned. I can only become a messenger and a conduit to those that are willing to implement what is at hand. I am not anything other but an extraordinary man that seeks extraordinary knowledge. I can't make you drink the water. I can only lead you to it. If you have any questions, you have the YouTube link. I suggest you ask your questions. I'll do my best to answer them because this is a civics class and notary training. And you're going to see how important it is for you to develop a formidable strategy in order for you to move forward for CECL implementation. Keep listening, because if you listen long enough, you just might learn something.
Committee is pursuing in New York legislation to address legacy contracts in New York State. Would the Fed support federal action in that regard?
Mr. Scott, so actually it's some members of the ARC. The Alternative Referendum Committee itself is not seeking legislation, but some members have approached the New York legislature. You know, in terms of the need for federal legislation, we have not reached a point where we think it's going to be necessary. We have plans to do that. If we do believe that federal legislation is necessary, we will come tell you. And by the way, we understand that that's not something you can do in 24 hours, so we know that the time for that is soon.
Very good. Let's move over to Great Britain for a moment. The UK regulators have been very direct with their financial institutions, and they recently established a goal for their institutions to cease LIBOR-based lending by the third quarter of 2020. So why has the Fed not been so direct? And do you have plans to set clear goals and guidelines for your regulated institutions?
Yes, we will do that at some point. You may have seen that Fannie Mae and Freddie Mac have said that they won't accept LIBOR referencing mortgages after some point later this year. So that sort of thing will begin to happen now, I think, well in advance of the deadline, which is the end of 2021.
Okay, and Chairman Powell, your Fed board recently finalized its rule on tailoring the hopes of providing more clear and well-defined risk indicators to determine the regulatory requirements that are placed on firms based on their size and risk. But the board has never disclosed nor provided clear and quantitative criteria under which firms are placed under its enhanced supervisory regime that is called Large Institutions Supervision Coordinating Committee. And even your vice chairman, Mr. Quarles, recently gave a speech where he said this. He said that he would like to align their portfolio with the tailoring categories and make the designation criterion transparent. And you even recently indicated that you agreed on the need for brighter lines. So could you outline what changes the Ford is considering to make in this supervisory framework?
We're just in the process of working out the specifics, but I would agree that we should provide more clarity around what is a LISIC firm, and that's really going to be the Category 1 firms.
Thank you. Now, let's move to, and you're a great man, a good friend. I respect you tremendously. But Chairman Powell, the Fed is the axle of our financial system. You are the most powerful regulator. And I want you to stand back up to Mr. Otting on this business of him coming with this rule-making change to the Community Reinvestment Act. Let him know that you not only have a mandate for inflationary monetary policy, you have a dual mandate, employment, jobs. And here's the other thing. You need to remind Mr. Otting that this piece of legislation, this law, the Community Reinvestment Act, is precious to the nation, but it's precious to African Americans more than anybody, because wasn't the Civil Rights Act, wasn't the Voting Rights Act that dealt with the big issue facing African Americans, financial stability. And the two anchors for that is a home, owning a house, and having a job. And this bill was the bill that outlined redlining that kept African Americans out. He needs to back off of that. You need to assume your power in this and let him know we're serious and to back off this rule change.
The gentleman from Ohio, Mr. Stivers, is recognized.
Now, family, if you're not paying attention, you're going to miss something very important. Why do you think, and I want you to put this in the actual chat, why do you think this policy is very important to African Americans? Why do you think monetary policy especially when it affects home ownership, is important to African Americans. Put it into the chat because I'm going to further discuss it, but I want you to pay attention. I just had to throw that in because it's going to get very interesting. And again, this is in real time. This is live. So, I don't have a crystal ball or anything like that, but I like for you to observe, like I said, welcome to my world. Keep listening because if you listen long enough, you just might learn something.
Pretty good shape. Would you say that's correct?
I would, and I did.
And you did. Thank you for that testimony. So your colleague at the Atlanta Fed stated recently that an economic expansion does not die of old age. I think that's a great quote. Given that the fundamentals of the economy are strong, do you think many businesses and investors are trying to talk themselves into a recession?
I don't think so, and I certainly hope not. There's no reason why the expansion can't continue. There's nothing about this expansion that is unstable or unsustainable.
Great. And I think the fundamentals are strong, but I think a lot of people are worried, and I hope that they don't talk themselves into a recession. I agree with you on that. Given that about 2/3 of all lending and capital formation occurs in the capital markets, I'm curious to hear about what the Federal Reserve is doing to actually coordinate with the Securities and Exchange Commission and the CFTC as prudential regulators for the capital markets to make sure that there's actual coordination on the capital markets.
Well, I mean, the SEC really and the CFTC really have primary regulatory authority for those markets, and we have supervisory regulatory authority over the banks. Where we overlap really is in financial market utilities, where we regulate some, and the SEC regulates some, and the CFTC regulates some, and we collaborate on all that. So we collaborate pretty closely on that.
Well, I would urge you to increase that collaboration because the lines between securities, banking, and capital markets are blurring more than ever before, and I would ask you and Vice Chairman Quarles to redouble your efforts for that coordination, because I do hear it from some of the firms that are regulated that they feel like it's not coordinated. So if you could redouble those efforts, I'd really, I think that would pay dividends to the American investor and the American economy. A couple other quick questions here. What do you think the most significant risk to the financial system is today?
So I have to start by saying that I think the financial system is strong and has been materially strengthened since the financial crisis, particularly the banks, high capital, high liquidity, stress tests keep them on their toes, and they have real resolution plans. None of that was really in place before. So I think the financial system is generally in a good place. The thing that we worry about a lot is cyber attacks. I think we have a great game plan for traditional issues like bad loans and things like that. It's more cyber attacks is really the frontier where you worry. And we work very, very hard on that. All the agencies do. We all work together. The institutions themselves work very hard. But that, I would say, is a major focus.
Thank you. And an interesting note, Mr. Chairman, you are in line with the CEOs of the biggest institutions. I asked them the same question, and the consensus, although not complete unanimous agreement, was that cyber attacks were the issue. I think Congress needs to focus on it. I think our regulators need to focus on it. Two quick things, because I'm running out of time. I know you're focused on the transition between LIBOR and SOFR. Some people have asked that question. I hope you'll pay particular attention to the impact on both small businesses and our community banks as we make that transition. They are particularly vulnerable. And with regard to the repo market, I hope you will continue to focus on the origins of the problem that caused it. Some are regulatory, some are market-based. And I know you're focused on it. You and I have had private discussions about it, but I'd like to see that solved in a way that you don't have to provide Federal Reserve capital at the end of every quarter or at the end of every year. So if you can stay focused on those things, I'm out of time. Thank you, Mr. Chairman.
Thank you.
The gentleman from Texas, Mr. Green, who is also the chair for the Subcommittee on Oversight and Investigation, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you for appearing today, Mr. Powell. Mr. Powell, this is an observation, not a criticism. You indicated that the fundamentals are strong. However, You also indicated at the last FMOC press conference that you were a bit surprised that wages have failed to move up despite being well into an expanding economy. Sustained levels of historically low unemployment and increased labor force participation. Fundamentals are strong. Strong, yet nearly half, 42.4%, of working Americans in 2019 made less than $15 an hour. Fundamentals are strong. Good many of the people in my congressional district, Mr. Powell, are more concerned about the supermarket prices than the stock market. When they go to the supermarket, they're concerned about the price of Procter & Gamble products, not the stock market price of Procter & Gamble itself. The stock market means nothing to them. It's what they have to pay for products in the supermarket. This brings me to my question. Has there been a study to give us some sense of what a $15 an hour wage will do for the economy? A study for what a $15 an hour wage will do for the economy. Has the Fed done such a study?
The Fed has not. That's not something we would do. But
Well, let me just address that, if I may. Don't mean to be rude, crude, and unrefined, but let me just call to your attention a study that I found quite interesting. The Carbon Disclosure Project. Good project. Based on thousands of disclosures, you've concluded that the 500 largest companies by market capitalization are exposed to $1 trillion in risk. Now, someone could argue that that's probably not something that you ought to do, although I understand that climate change is something that is important to the Fed because it will have an impact, global impact. But I think you can take a closer look at this. You're the ultimate authority on price stability, on wages. Let's have a study to determine what impact a $15 an hour minimum wage will have on the economy. A wage disclosure project, if you will. Give me some thoughts, Mr. Powell. Can you help us, please?
There's a great deal of research that's been done on minimum wages, and I don't know of a particular one, but there has to be somewhere research on what a federal $15 wage increase.
And I agree with you. I agree. I've read a few. But they don't come from the Fed. They don't come from the entity that has the dual mandate, price stability, unemployment or employment. It would mean something to working people if we could get such a study, notwithstanding what others have done. And these are observations, Mr. Powell, not criticisms. I've enjoyed visiting with you. Notwithstanding what others have done, this would be meaningful to working people. By the way, I think $15 an hour is not enough as a minimum wage. I think it ought to be at least 20 now, but I'll still settle for 15 if we can get that. So can we work with you, discuss with you the possibility of a wage project?
You know, again, I'll go back and talk to our labor people who know this issue very, very well, and many of them have published on these issues. So let me come back and.
I'm going to thank you for it. I've got 46 seconds, and I'm going to applaud you for it. Personal applause. Madam Chair, with that, I will yield back the balance of my time.
Thank you very much. Is the gentleman requesting to have an answer in writing for the record on this question to the chairman?
Yes, Madam Chair, thank you.
The witness is requested to provide an answer in writing for the record. Thank you. The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Madam Chairwoman. Chairman Powell, welcome back to our committee. And I want to first touch on your testimony about the importance of fiscal policy in supporting the economy. In general, what would you say is the lag time associated with a major change in fiscal policy?
Well, it can tend to be long, as you know. With monetary policy, we can go into a room and change interest rates, and do. Obviously, fiscal policy tends to take a lot of a lot of work and some time.
Well, let me ask you this. Let me ask the question this way. Fiscal policy has changed profoundly in the past 3 years. Tax cuts, deregulation, a less restrained energy sector, a pullback from Dodd-Frank, repeal of the individual mandate, new trade deals. Are any of these policy changes impacting current economic conditions?
I'm sure they are, but of course we don't try to assess that. That's not really what we do when we look at the economy. But yes, they would be affecting.
As you noted in your testimony, the U.S. economy is presently exceptionally strong. Since the 2016 election, 7 million new jobs have been created. The unemployment rate is at a 50-year low. More Americans are employed today than ever before. Wage growth is the highest in a decade, and the lowest income workers have been seeing the fastest pay increase, growing at 16% since the 2016 election. And just over the weekend, this was the headline of the Wall Street Journal, which I'm sure you follow, and the reporting was that a tight U.S. labor market is drawing Americans off the sidelines at a record rate. Despite this, after last week's State of the Union speech, Speaker Pelosi said that it was, quote, appalling to hear the president, quote, try to take credit, unquote, for an economy he inherited. Now, Chairman Powell, I'm not going to ask you to weigh in or arbitrate a domestic political dispute, but when the FOMC conducts monetary policy, given what you said about the lag time of fiscal policy, is it fair to say that this president's policies are impacting today's economic conditions?
At a high level, of course they are.
Let me follow up on Representative Wagner's question about the GSIB surcharge. In your response to our letter, you maintain that you aim to have the, quote, key components, unquote, of the stress capital buffer finalized in time for the 2020 CCAR. Can you describe in more detail what the key components are and a more precise timeline, given that the Fed announced last week scenarios for the 2020 CCAR?
So I think the timeline is we do intend and will put into effect the core of the stress capital buffer in time for the 2020 CCAR cycle. So that's coming right up. I'd prefer to leave the exact details of that to that are still being worked out, but it will happen in a timely way for the 2020 cycle.
Understand. Well, let me try to get just a little bit more detail. Is it still the Fed's view that the activation of the countercyclical capital buffer is a suitable replacement for the dividend add-on in light of the board's financial stability report from November, which stated that the vulnerabilities have not significantly changed?
We haven't made a decision on that, on using the countercyclical capital buffer versus the other approach. We have not made a decision on that.
Okay, thank you for that. We're looking forward to that decision. Final question. The Business Roundtable, as you probably remember, announced last summer that it was redefining a corporate purpose to elevate so-called stakeholders ahead of shareholders. A large investment firm recently announced its intent to divest of fossil energy, effectively limiting investment options for clients to a subset of sectors that check the environmental, social governance box. I am concerned that firms which arbitrarily limit investment offerings based on social and political pressure may choke off capital to perfectly legal, productive, and profitable sectors of our economy and cause retail investors to miss out on returns that they need to fund their futures. As a leading voice on the Financial Stability Oversight Council, will you commit to raising this issue with your colleagues at FSOC and urge that body to examine the extent to which a misallocation of resources away from shareholders to serve unrelated political errands might stifle capital formation, compromise investor returns, and ultimately undermine financial stability?
I don't know that I totally understand your concern, but I'll be happy to discuss it with you.
Well, the concern is that if shareholders are not a prime concern of corporate boards and directors, if stakeholders who have no ownership interest in the company are the focus of a corporation, then I would submit that there is a tremendous risk of misallocation of resources away from maximum shareholder returns. And I would like FSOC to take a look at that.
The gentleman yields back.
I will bring that to the authorities at the FSOC.
Thank you. I yield back.
Gentlewoman from Ohio, Ms. Beatty, is also the chair for the Subcommittee on Diversity and Inclusion, is recognized for 5 minutes.
Thank you to the chair and to the ranking member, and thank you, Chairman Powell, for being here here today. Let me also acknowledge the advocates in their green T-shirts for being here today, and thank you for coming to my office yesterday and sharing what I thought was valuable information with my team. Appreciate you sitting through the hearing. Chairman Powell, in the latest edition of the Federal Reserve Survey, Consumer Finances, that was published in 2017, and it gave the breakout between whites, blacks, and Hispanics as it related to their net worth. And we've heard the statistics. I think my colleague, Congressman Meeks, talked about it, and I'm sure some others, so I'll spare going through all of those details. But what's very interesting to me, while that data seems great for those who are researching the issue, is there any way your office could break it down by regions or cities? Because when we go back home, this is one of the #1 things that I'm hearing. People are coming into my office once you get through health care and this couples in with jobs and education. They're saying is we look at the wealth gap, that it's getting wider, it's not coming in. And while we're talking about unemployment rates being better, many people have to work 2 and 3 jobs just to try to survive. Someone talked about the minimum wage. Certainly, as we're advocating for a higher number, it's not enough. In my district, you'd have to make somewhere between $18.70 and $20 to be able to have a livable wage. So the first question is, can this information be localized to a region or to a city to help us as members of Congress when we go back home? The second thing is, I just recently introduced a bill closing the racial wealth gap, which requires the Federal Reserve to further break down the data. And this is something that I didn't realize until really studying the Federal Reserve, listening to some of the individuals like the folks here today. They have some really good ideas. And so my second question is, could you tell me if you would entertain having your folks look into looking at wage as a measure? Because oftentimes, when you look at, many folks don't work a full-time job, but they have a wage. So could we be a little more creative in looking at the data based on what some of the things that I'm hearing from the group that came in? And I'm sure they've met with your folks and you know some of their issues. So I'll start with 2. Can it be localized? Can we entertain looking at some of the things that they think we should look at when we calculate or present all the good news that is not the good news for many of the individuals sitting here or in my district?
I think you're probably making some of our data people very happy back at the Board of Governors.
Okay.
You know, they love to cut the data different ways, and we do learn every time we do that. We learn things. I don't actually know the precise answer to your question of whether we can do it regionally or in what dimensions we can, but we'd be happy to look into that for you.
And what about some of the individuals' ideas about looking at wages in your calculation?
Yes, we can. I think we can do that. I think
So your folks would be willing to work with them on some of the ideas to at least start at a starting point of discussing it? Because now we're marrying the people with the power. And what a good win-win that would be for all of us, since we're really talking about all of our lives, and especially those who, you know, have to work a little harder than some of the rest of us. And so then the next thing, will your agency work with my office? I am so excited about this bill. And as I understand it, part of the reason for asking for the data is the Federal Reserve actually collects the data that sets the policies that then get married with the allocations that come back to the districts. So I want to make sure I'm on the right path when I go back home and I say I have a bill that's asking the Federal Reserve to collect data that can help us in the end. Is that
Yes.
in the ballpark?
We should actually get the experts to talk directly to you and your staff and tell you what we do and how we do it and how that might be useful. I don't know that we need legislation at all, but we certainly have excellent sources of data, and we do cut them different ways. So why don't we just try to follow up with you on that?
Thank you.
Gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Madam Chair, and Chairman Powell, thanks for taking the time to be able to be here this morning. Did want to follow up a bit on the CRA. We've had a fair amount of conversation on that, and just wanted to be able to have the clarity that the Fed has been involved with the CRA process with the OCC and the FDIC. Is that correct?
From the very beginning.
Great. And also wanted to get some clarity. Were you comfortable not only with Governor Brainerd making the speech, but the content of her speech in regards to the CRA?
Yes.
Okay. What extent has the Fed been doing? I know you're talking about doing some of the analysis comments coming in, but to be able to work on CRA modernization.
So from the very beginning of the process, we said, yes, that sounds like a great idea. It's a good time to update CRA. Let's try to make it more transparent, more objective. Let's try to make it more effective in serving the intended beneficiaries. And so we too went around the country. I think we had 29 events around the country where we talked to different groups of people about CRA, their experience of CRA, and it turned us in a particular direction. We had a bunch of ideas, and it's unfortunate that we weren't able to get on the same page. We weren't able to really agree completely with their approach, and they weren't able to completely agree with ours. So, but we continue to push and we continue to learn, and I would agree with Mr. Hill's earlier comment that ideally you would have one agreed set of standards.
I would agree with that as well. I think that harmonization is something that we certainly ought to strive for. Was really encouraged reading your comments and your statement that people who live and work in low and moderate income communities are finding new opportunities. Wages have been rising, particularly for lower paying jobs. That's an area that I have a lot of concern on. In my state of Colorado, I represent the rural areas, and we've oftentimes had two economies, to where the metropolitan areas, resort areas have been doing well. Rural areas have continued to often struggle. We're now starting to actually see some of that real movement. But when we're looking at that CRA reinvestment back, talking about the community banks, I really would encourage you to be able to look at that OCC and FDIC proposals. I believe they do reach further into rural America. And you talked about policy. Have you done any assessment in terms of the opportunity zones that were included in the Tax Cut and Jobs Act? We're certainly seeing some benefits and some investments coming into rural areas in my district. Is those some of the policies that we need to be looking at?
I'm not aware of any research that we've done on opportunity zones, but we probably have. Truthfully, in the system, I would imagine we have done research on that, and we'll be happy to share it with you.
Great, thank you. And Fannie Mae and Freddie Mac just took some steps talking now about SOFR, to be accepting SOFR-based mortgages. And I've noted that other agencies have been taking this step separately. Is there any kind of uniform effort at a high level to be able to coordinate the adoption of SOFR?
Yes, there is, very much so, and we're doing that. We're coordinating with the other agencies and with the market participants as well. And you will see more of that. You will see more instances in which LIBOR will no longer work, will no longer be usable in particular contexts. And that's what Fannie and Freddie did this week, or announced this week.
And to follow up on Mr. Stiver's question in regards to community banks, do you see any pluses, minuses in regards to using SOFR over LIBOR for community banks?
Yes, I think LIBOR itself is really a problem in the sense that the rate, there's no guarantee that the rate will continue to be published after the end of 2021. But there's a question about having a credit-sensitive rate in addition to SOFR. SOFR will be the main substitute for LIBOR, but we are working with regional and some of the larger banks too about the idea of also having a credit-sensitive rate, and that's something that's ongoing.
Okay. And we've had a little conversation about the coronavirus, China, the impacts on the economy. President just signed into law the USMCA. Do you see that as creating a runway for further economic expansion in the U.S., job opportunities and wage growth?
We don't give advice on trade policy, and but I would say that, I would just say this, that I think the signing and the enactment of and implementation of USMCA will be a positive, at least in the sense that it removes uncertainty around trade policy, and I think that's been part of the issue of the last year or so, has been not knowing what the rules of the game are going to be. I think getting those rules settled is certainly a positive thing.
Great. Thank you. My time's expired.
Thank you. The gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Yeah, Chairman Powell, well, first off, I'd like to thank you for facilitating our meeting with Governor Brainerd. Representative Hill and I had on digital currency. We really enjoyed that, as well as the meeting with the staff, who are excellent, and it's great to see how plugged in they were to this issue. Now, in a speech last week, Governor Brainerd highlighted, quote, the role of central bank digital currencies in ensuring that sovereign currencies stay at the center of each nation's financial system. Do you agree with her characterization? And in particular, do you think that establishing a digital dollar would help ensure that the U.S. dollar continues to serve as the core of the U.S. and the world's financial system?
Well, to take the first part of that, I think having a single government currency at the heart of the financial system is something that has served us well. It's a very, very basic thing that really hasn't been in question. And I think, you know, before we move away from that, we should really understand what we're doing. So I think preserving the centrality of a central, widely accepted currency that is accepted and trusted is an enormously important thing. I think whether a digital currency moves us along that path or not is an open question. As you know, every major central bank is currently taking a deep look at that we feel like that's our obligation. Technology has now made this possible. Private sector's innovating, they're doing it, so I think it's very much incumbent on us and other central banks to understand the costs and benefits and trade-offs associated with a possible digital currency.
So how would you characterize your state of progress on this compared to other countries? The Swedish central bank developing an e-krona, the Chinese. The reason that one of the reasons there was so much concern about the Libra project is they would immediately have scale if they just rolled out the product. Another entity in a position to do that is the Chinese government, to roll out at scale using their already established payment by cell phone systems. They would immediately have a scale comparable to Facebook if they rolled that out. And so how would you characterize our ability to respond to this potentially competitive threat?
So we're working hard on it. We have a lot of projects going, a lot of efforts going on that right now. We haven't had the problem that many of you mentioned. Sweden. A lot of the Northern European economies have moved away from cash to a remarkable degree, and that really has not happened in the U.S. economy, even though it seems like it must have happened with our kids not using cash very much. Nonetheless, the amount of cash in the U.S. economy continues to grow at faster than nominal GDP. So we're in a different place on that.
If you look at the curve of adoption of payment by cell phone, it starts slowly and then all of a sudden it just happens. And so that seems like that transition can happen in a period of just a couple of years. And so we have to be able to respond. If that's the driving factor, then we have to be in a position where we can respond by rolling out, for example, a digital dollar on the couple of year time scale. And so
I completely agree with that. And I think, frankly, Libra really lit a fire under that, and it was a bit of a wake-up call that this is coming fast and could come in a way that is, that is quite widespread and systemically important fairly quickly if you use one of these big tech networks like Libra did. So we're working hard on it. We fully appreciate the importance of making quick progress. We have not decided to do this, though. It is not. I think that there are many questions that need to be answered around a digital currency for the United States, including issues of cyber issues, privacy issues, Many operational alternatives present themselves, and so we're going to be working through all that and doing that work thoroughly and responsibly, but with some
Do you feel
urgency.
as though you have adequate visibility into what the Chinese are doing on this? Do you have sort of working level contacts that give you some idea of what their rollout is likely to do, likely to look like?
Yes, I mean, I don't, we certainly have that, but you know, they're in a completely different institutional context. There are things that, for example, the idea of having a ledger where you know everybody's payments, that's not something that would be, you know, particularly attractive in the United States context. It's not a problem in China. So, but nonetheless,
But so
we're-
from a
we're following
competitive
that
point of view,
closely.
they're claiming they're going to roll it out on the Belt and Road countries sometime very quickly. And so this, you know, I urge you to keep the fire lit. Thank
Will
you.
do. Thank you.
The gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Madam Chairman, and thank you for coming back to our committee, Chairman. We appreciate it. And with baseball season slowly approaching, I wanted to make sure one thing before I continue, that you still are on Team Capitalism.
Oh, yes.
Thank you. Appreciate that. Experian recently released their 2019 Consumer Credit Review, and I wanted to read a section from the report because I think it accurately depicts the state of our economy. As you know, I'm a Main Street business guy, and the economy is really good right now. Indeed, the U.S. economy exceeded expectations. Record job growth caused unemployment rates to drop to historic lows while the stock market flexed throughout the year. Consumers, in return, showed their confidence as they continue to borrow and spend energetically, most recently evidenced by the strong 2019 holiday shopping season. The report goes on to say that consumer credit scores reached an all-time high in 2019 at an average of 703. This translates to people being able to get better rates to borrow money, to buy a house, get a small business loan, or whatever they need financing for in order to live out their American dream. So, Chairman Powell, what should we be focusing on in this committee to continue for jobs explosion and new jobs that we have seen the past few years?
Honestly, I think the focus for me really ought to be on things that address what are our longer run issues that can be addressed by legislation. And it's really two important things. One is labor force participation. What are the things that you can do that we really can't do that will help people stay more attached to the labor market? We still have low labor force participation compared to essentially all of our economic competitors. And the other one is productivity. So what is it that drives productivity? It's a stable legislative environment. It's a legislative and administrative environment that supports growth and innovation and investment and those sorts of things. So those would be my main focus.
Okay. I know you're aware about the Fed's work on the International Insurance Capital Standard that is being developed for the world. I've had my reservations about entering into an international agreement that does not conform with our current state-based approach to regulating our domestic insurance companies. One particular piece of the international standard that I want to ask you about is the flexibility that our government was given to develop an equivalent solvency standard that would better fit our insurance ecosystems. So my question to you is, how does the Fed plan on ensuring the standards being developed in the U.S. will be deemed equivalent by the international group, given this continued resistance you're facing from the Europeans?
I can just say that we will not be part of approving any international standard that doesn't accommodate our own American insurance regulatory framework.
That's great. We're leaders, not followers. Some of my colleagues on the other side of the aisle have called for a financial transactions tax. I think this is an extremely short-sighted approach to raise revenue that will greatly impact the amount and the ways that Americans save for the future. Additionally, the thought that adding an extra layer of taxation to other assets is redundant since capital gains taxes are already in place and they should be lowered that take away money from successful investments. So if we want to further expand economic growth, we need to focus on continuing to lower the personal and corporate tax rates so Americans can keep more of their hard-earned incomes and businesses can invest that profit back into their operations. So, Chairman, can you explain how implementing a financial transaction tax would impact the U.S. economy?
I think I need to stay in my lane here. You know, we don't do fiscal policy. I don't want to if I start commenting on particular taxes, I'm worried about where that might go. So I'll have to.
Well, I understand that. I'll tell you from a Main Street standpoint, it will really hurt the economy, an extra layer of tax. We need to actually cut taxes. So looking at financial trends across the world, and with being in business for over 50 years myself, one data point is that catches my eye are negative interest rates. Can you help me understand the economics behind negative interest rates and talk about the potential threats that this phenomena poses to financial stability?
Well, a number of countries around the world, as you know, face the problem of what do you do when your policy rate gets to zero. And some of them actually went below zero. The United States chose not to. We chose not to at the Fed. We used other tools when we got to the lower bound, and those were forward guidance and large-scale asset purchases. I think going forward, our inclination would be to rely on the tools that we did use, as opposed to negative rates. So that's our instinct, is that in the U.S. context, that's not a tool we're looking at. You know, the question about intermediation is when you have negative rates, you wind up, does it wind up creating downward pressure on bank profitability, which limits credit expansion?
Right.
And there's some evidence of that. So in any case, we were watching other institutions around the world who've done that, and we'll be able to, to see what the results are.
Thank you for being here.
The gentlewoman from Michigan, Ms. Tlaib, is recognized for 5 minutes.
Thank you, Madam Chair. I don't know if you know, but in 2013, Chairman, Detroit filed for Chapter 9 bankruptcy, which was marked as the largest municipal bankruptcy filing in U.S. history. In July, when you were here, I asked you why, if the Federal Reserve is willing to backstop or support, big banks and corporations during periods of credit market distress, that we wouldn't want to make equally sure that state and local government also had access to credit as well. And you mentioned that you didn't have the authority to lend to local and state governments. Madam Chair, I'd like to submit for the record Section 14.2b of the Federal Reserve Act, asserting that the federal government, the feds, actually do have the authority to buy municipal debt.
Without objection, such is the order.
So, Chairman, given that you actually do have the authority, can you explain to me why we shouldn't, why shouldn't the Federal Reserve ensure that state and local governments have access to funding during times of stress?
So we have, as you know, limited authority. I think it's to buy short-term municipal obligations. We did do that in the 1970s briefly, and then have not done it since. I think a series of FOMCs and Fed chairs in all kinds of different political environments have thought of that as something that's not appropriate really for us, in the sense that it's government finance. That's to be dealt with by fiscal authorities rather than by the monetary authority. We focus on the job you've given us, which is maximum employment and stable prices, and to some extent also we're, with other agencies, we work on financial stability and bank supervision.
So, Chairman,
as opposed to the solvency of state and local government.
Well, yes or no, the Federal Reserve retains the ability to open emergency lending facilities. Is that accurate in stabilizing the economy?
Well, to financial institutions, we do.
So when the Fed step in to rescue banks in a crisis, is that because you believe their role in the economy is vital?
Well, really, because we had no choice to prevent the financial system from collapsing in 2007.
Yeah, no, I mean, my city filing bankruptcy was devastating to so many retirees, sir. 40, 50 years, they worked for the city of Detroit, saw their pensions completely diminished, gone. Do you not believe that the governments of Detroit and Puerto Rico also play a vital role that should be preserved, even if financial crisis makes it hard for them to borrow money?
What I believe is that that's not a job for the Fed. The Fed has a particular role and particular authorities, and lending to state and local governments and supporting them when they're in bankruptcy has not been part of our mandate.
We're going to strongly disagree. I do believe you do have the authority. Now, you've mentioned that in the face of another financial crisis, you would use the same tools of expanding the balance sheet and purchasing long-term, in other words, more of the same, correct?
Yes.
So I'm afraid that's simply not good enough. I mean, I think your predecessors, former chairs Yellen and I believe it's Bernanke, seem to agree based on remarks both that gave last month. For instance, Chairman Bernanke has suggested a money finance fiscal program might be helpful during the next recession. Do you agree with that would be helpful?
You know, I think that's really an untested and not widely supported perspective. I don't believe Chairman Bernanke said that a money-supported fiscal policy would be something that we should do. I know that there's been a group of people that have pushed that idea, but I don't think it included former Chairman Bernanke. You may see something I haven't seen.
I know. And Chairman, look, the federal government is supposed to be about people. And I don't see that we're treating, pensioners, a city like the city of Detroit, which is frontline communities that have really been hit hard by the financial recession. I mean, we haven't actually. They keep saying Detroit's coming back. If I show you neighborhoods, they'll tell you, we don't know what you're talking about because poverty's actually increased, access to housing has decreased. I mean, all of those things. That we start reflecting and understanding that I believe the Federal Reserve Act actually gives us authority to help and treat, just like we bailed out big banks, that we can do the same for our people, the residents of the city of Detroit. So I thank you for that, and again, would actually ask and push you to looking at this from a different lens versus what the same old, the same old process, which I believe hasn't really worked for working class people. Thank you so much, and I yield the rest of my time.
Thank you. The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
Thank you, Chair Waters. Again, Chairman, welcome back to the House Financial Services Committee. I want to thank you for your discussion that you had with Dr. Foster a few minutes ago. I, too, want to thank you for your work with Governor Brainerd and our discussion that we had with the governor and the staff about the concept of a digital dollar and the work being done at the Treasury about that. I won't belabor some of the points that Representative Foster made, but a couple of comments that I'd have for you on that. Would you advise our committee, or ask the Fed to advise our committee, what legal authorities the Federal Reserve might require in order to consider the use of a digital dollar?
Yes, I mean, that's a good question, and it's one we're looking at. A lot of it would depend on the design of that currency.
Exactly. And one thing we also talked about, and we've had a lot of discussions in our FinTech task force here, is about Europe's approach to this idea of a payment provider license, which is now part of their financial services code, part of their open banking movement, and the idea that one would have a regulatory license here in the United States for being a payment provider. It might be a bank or it might be a non-bank. Is that something the Fed's looking at as well?
I wouldn't say we're specifically focused on that, though, but you more broadly, it's, we think, a good idea to look at the whole landscape of oversight of our payment system, and that would be a piece of that. And as you may know, Governor Brainerd talked about that in another of her speeches last week.
Right. Thank you for that. Last month, the Chinese regulators bailed out Hingfang Bank. It was a $14 billion loan that they arranged through one of their sovereign wealth funds. The Chinese banking assets at $41 trillion now are 47% of world GDP. Is instability in Chinese banking industry pose a financial threat to the global financial system? Is it a financial virus, like they've already contributed a physical virus?
You know, generally, as I'm sure you're aware, China has had very high debt to GDP for an economy at its stage of development, and that includes the banking system. And the government has actually, for several years now, been taking measures, led I think by the central bank, to try to control the growth of debt. And they've stuck to that through the last couple of years, even though those were challenging years economically for them. So it's something that they're addressing. The other thing is that they have plenty of fiscal space. If you look at fiscally, they have plenty of power to respond to downturns. So I wouldn't go so far as to say that their debt is a systemic threat to the world economy or anything like that. And it's something that they need to address and are.
I think it's something that I think deserves review. Mr. Barr talked about their misallocation of resources. At 47% of global GDP, that seems like an overallocation in the banking sector in China and could pose a threat to our system. In your report on page 24, you talk at length on your financial stability section about the decline in bond yields, particularly in the high yield market, the ratings have fallen. And I was looking at a mutual fund annual report the other day, and it says, a particular concern is the continuing high rate of issuance of BBB bonds, the lowest category of investment grade rated bonds. If the economy stumbles and rating downgrades issue, it could be a flood of fallen angels. And this particular mutual fund said they're staying away from the lower end of the high yield market. Are you concerned about the high yield market?
Well, that's the so-called BBB cliff, and the idea is that there are a handful of very large issuers, which if they were, downgraded, would then be non-investment grade, and the idea is that some holders are not permitted by the terms of their agreements with their investors to hold non-investment grade, and that might trigger sales. So that's an issue we've been monitoring for some time now, really. With leverage lending more generally, yes, we're monitoring it very carefully. You do see, low compensation for risk taken. You see high leverage. You see a lack of covenants. You see all of that. I think it's a complicated picture, though. That paper is now largely held in CLOs and not on mutual funds and exchange-traded funds, rather than on bank balance sheets. So, and those vehicles tend to be stably funded in the sense that their liabilities are actually longer than the expected maturity of the underlying instruments that are held.
It's still a source, I think, of financial concern to the FSOC, I would think.
It is.
And therefore I commend you for noting it in the report, and thank you for your continued attention to it. Yield back.
Thanks.
The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell. I appreciate you sticking around all the way to the bottom of the dais here. If I get elected 8 more times, fingers crossed, I'll have as much experience in this line of work as I do in the energy sector. So I still come here primarily as an energy nerd, and I have a real concern that we are not dealing with the realities of climate change scientifically. We understand viscerally what it means to have rising sea levels, but we haven't really thought about what it means to have an accelerating rate of change. Compound interest confuses people, and compound changes in the environment, we don't even really think about it as well as we should. Just a couple data points that I hope all of us can appreciate. The first evidence that hominids made fire is a cave 1 million years old. James Watt invented the steam engine in 244 years ago and ushered in the Industrial Revolution, and 50% of all the CO2 we have ever emitted as a species is since Back to the Future came out in 1985. This is this massively accelerating shift, and if we went to 0 CO2 tomorrow, we're looking at 2 feet of sea level rise coming. The more realistic trends we're on is at least 6 feet of sea level.
All right, family. I'm about to take you on a financial roller coaster here. A financial roller coaster that if you pay attention, you will definitely learn something. Now, what you're hearing, I will be airing in its entirety in tonight's segment. So just don't panic. It will actually be on tonight's training session and broadcast. I wanted to just kind of bring you into my space for just a second, so you can kind of understand what's at stake right now. Because Chairman Powell of the Federal Reserve has given you some very revealing information. And I kind of think if I don't really elaborate on that right now, you're going to miss what was actually said. Because see, I know for a fact, just in the aspect of being in the space that I am, that most individuals have no clue on the Financial Services Committee and their role with FASB. I know for a fact that most individuals, when we talk about current expected credit losses, are still scratching their head trying to figure out, well, tell me again, how does this affect me? I know the majority of people that look like me and you are more worried about them getting their income tax refunds before April than actually what was just discussed. And this is very dangerous because the banks have already abandoned ship, and the Federal Depository Insurance Corporations, or what we call FDIC, has already made a list of all creditors that are liable for this shift. How many of you guys actually caught what was being said about silver being used to back mortgages? They are introducing silver-backed mortgages. Let me explain to you what that means for those that are dealing in mortgage-backed securities. I have been an advocate for moving clients to mortgage-backed security proponents since the early millennia. Matter of fact, as early as 2005, I have been heavily engaged into mortgage-backed securities. I used to work for a company called Thornburg Mortgage before I started being on the radio broadcast. I was a loan officer there. PAL, which is Pledged Asset Lending. We knew way back then how impactful it was, but they were doing these things privately, and they got what is called a reverse merger. Once the Real Estate Investment Trust, the REIT, got large enough where they could stop dealing with the public, they stopped dealing with the public. Now, you're hearing the feds say, and I quote, "We have already implemented silver-backed mortgages." The mortgage-backed security industry has already moved assets in that direction. Now, let me explain to you what that means. They are now dealing with asset-based securities, asset-backed securities. They're moving away from debt derivatives. And there's a reason. The bubble that burst in real estate was a purposeful bubble because in order for them to stay on top of where they are, they have switched places with the true heirs of the estate. And unless you have true assets, you are emotionally correct, commercially wrong. Now, I'm going to give you what I posted in the actual quote-unquote chat, just so you're clear on what I'm articulating. Now, I'm going to read it in its entirety so I don't break my train of thought. I'm going to do this so I don't break my train of thought and everybody can actually get in where they fit in terms of what I'm talking about. All right, here we go. We're going to start. Here's the financial crisis. In 2008, the 2008 financial crisis led to the Federal Reserve to take a novel approach to the monetary policy. To improve the overall financial conditions, the Federal Reserve reduced the Fed funds rate to nearly zero and provided additional forward guidance to the markets that the Federal Reserve intended to keep interest rates at this level for an extended period. However, this strategy proved insufficient as economic conditions worsened. As a result, the Federal Reserve engaged in large-scale asset purchases of treasuries. What did they do? They went on and engaged into a large-scale asset purchases of treasuries and agency mortgage-backed securities. Agency mortgage-backed securities, MBSs. And they referred to this as quantitative easing, QE. Quantitative easing. The QE program, which lasted from November 2008 to October 2014, sufficiently increased the size of the Federal Reserve's balance sheet from $870 billion in August to $4.5 trillion in 2015. The large balance sheet has resulted in the Federal Reserve remitting sufficiently more in net income to the Treasury. So they have been buying their own paper. And they are now in a position where they now are bartering with silver. I am going to say this unequivocally. If you understand what banking in the box is all about, and you understand what current expected credit loss implementation is, and you understand that if you have not substantiated your accounting, you are in the best seat in the house to utilize the ability to recapture and recover assets in these mortgages and move into a large scale asset purchase proponent, because the treasuries have been repetitioned for you to do so. But you gotta have a notary and someone who is willing to do the accounting in order for you to be substantiated. And if you can't grab what I'm putting down, I'm going to say this unequivocally. There are individuals right now in this space that are in a position to not only do this, but be very private about this. And this is what you got to remember. These rules preserve your right to contract the way you see fit. I have to now show Moors from this particular training with the notaries what rules apply and what rules don't. I hope you're picking up what I'm putting down. I hope this is coming in loud and clear. Someone please send me a message to make sure that I am coming in. The quality is pretty decent. You understand what's being said and what's being done. Because what I'm about to go to now is going to be a breakdown. So let's go there, shall we? Let's go to the breakdown. Because I want you to really, really, really understand what this whole breakdown is about. Let's go there. Let's see. Let's see if we can go to the breakdown. Let's see. All right, here we go. Yeah, this is a judicial notice. I know some of you Moors are like, wait a minute, I haven't seen that before. Well, I hope you have, because I need to reiterate a couple of things. And this is just for educational purposes only. I need to reiterate a couple of things. Now, I want you to understand this is a judicial notice and proclamation. Most of you are Moors. Most of you that are Moors, those of you that understand what a Moor is, this should not be new to you. But I want you to observe. Just observe this for me while I go over this. This is a judicial notice and proclamation. To all elected United States Republic officials and public servants of the federal, state, and city and municipal governments, personnel, and corporate entities concerning the Constitution and all the statutory and civil law codes of the land, etc. Now all men by these precincts. Upon my inherited nobility, upon my private aboriginal indigenous proper person status and commercial liability, I, which will be your name, appellation, being duly affirmed under consanguine unity, and if you need to look that up if you don't know what that is, pledge my national, political, and spiritual allegiance to my Moabite Moorish nation, being the archaic aboriginals indigenous of Amexem and the Americas, standing squarely affixed upon my oath to the 5 points of light, which is love, truth, peace, freedom, and justice, do squarely affirm to tell the truth, the whole truth, nothing but the truth, and having the knowledge and firmly established below or belief upon the historical, lawful, and adjudicated facts contained herein, being competent in my own proper person to attest to this affidavit upon which I place my signature, whereas I state, proclaim, declare the following to be true, correct, certain, complete, not misleading, supreme, not intended to be presented for any misrepresented, colored, or improper use or purpose to writ. It's going to get interesting now. Don't worry. I'm like, well, Basil, where you going? That I, and you put your appellation, am a noble of the Almoroccan Empire, North America, in proper persona. My own proper self, being Moorish American, a descendant of ancient Moabites / Moors by birthright, freehold, primogeniture, and inheritance, being aboriginal and indigenous to the lands of Mexican Americas, territorium, in my ancient Moabite Moorish forefathers, to wit, that the Almoroccan American continents are the land of the Moors, being North American, South American, Central American, including the adjoining islands Americano, Ameru, Almoroc, I have acknowledged, claimed, and possesses by said inheritance primogeniture the freehold status thereto, all unalienable and substantive rights to be, to enjoy, to act, distinct in my Aboriginal customs and culture, and determining my own political, social, and economic status of the state, turning my heart and mind back to my ancient mothers and fathers, Moors, by divine natural right, being Moorish Americans. We have and possess the international recognized rights to determine our own status of state, absence of threat, coercion, and acquiesce to a color of law, a color of office, nor to be subject to an imposed color of authority. Moorish Americans, Moors have proclaimed, possess the unalienable substantive rights and birthright, which means the inheritance to all our Al-Moroccan names and nationalities by nature's law, divine law, primogenitura, and by the recognized laws of the nature of the earth, international being the true ancient aboriginal indigenes, indigencies of the land, America, North being the highland and Moroccan Empire, Moors of the de jure, you need to look up de jure, freeholders by birthright, inheritance, and primogenitura status, and have, claim, and possess the secured rights to travel upon the public roadways, byways, and highways of our continental United States, which is the organic land, absent of foreign colored or imposed excess taxation constraints invented by the racketeering states legislators to abridge and steal rights belonging to the natural people. These substantive rights are asserted by royal law, Moorish law, Muslim law, the law of the great peace, law of the nature, divine law, nature's God, the laws of nations, the free Moorish Great Seal, Zodiac Constitution, affirmed by the Articles 4, Article 7, no, that's Article 6 of the Constitution Covenant of 1774 through 1781 AD, which equals 1201 Moorish calendar, as lawfully adopted for the United States Republic, establishing its republic form of government. Said Constitution established the people's supreme law of the land to secure the rights of the people and to keep the government bound in the check of the official oath and the official bound down from the ancient ones. In the promogenitors comes the supreme law of the land. Egypt, the capital empire of the dominions of Africa, the inhabitants of Africa, and the descendants of the ancient Canaanites from the land of Canaan, the Moabites from the land of Moab, who received the positions and pharaohs of the Egypt to settle and inhabit the northwest Africa. They were founders and are the true possessors of the present Moroccan Empire, who with their Canaanite, Hittites, Amorites, who sojourned from the land of Canaan seeking new homes, their dominions and habitations extended from northeast and southwest Africa, across the great Atlantis, even until the present North, South, and Central America, also Mexico, the Atlantis Islands, before the great earthquake which caused the great Atlantic Ocean. The Great Seal Pyramid is the national emblem and signa of the Moorish nation, empire, North America, geological location. The Great Pyramid is also the archaic symbol for civilization on the planet Earth. The Honorable Moors acknowledgement of our Great Seal indicates those heirs who own up to, who support, who proclaim our free national government, Moors who are active and not passive in the social, civilization, culture, and custom matters involving law, order, governmental principles, are hereby entreated, and look up the word entreated, to support this affirmation. Moors Moors who strive towards this end with the honor are entrusted by Noble Drew Ali to help in the great humanitarian work of uplifting ourselves, our fellow man, and humanity at large. We seek at all times to be conscious of the works, instructions, and acts necessary to teach, preserve, defend the birthrights of all Moorish Americans, Al-Moroccans, etc. The noble Moors / Moors, heirs apparent, are the natural members / citizens of the ancient Al-Moroccan Empire, North America, and are duty bound to recognize and support our Great Seal, sovereign Moorish government, and nation of the natural people, and command the enforcement of our Constitution. Thus, such organized communication orders are referred to as the Great Seal National Association of Moorish Affairs, the Free Moorish Nation, inclusive to all Aboriginal, Indonesian, indigene tribes and provinces of the national people, etc., all rightful bearers of the names and titles of Ali, El, Bay, Day, and Al. The free Moors by freehold inheritance, retain all substantive rights and immunities, enjoyed the exercising of substantive rights and operating upon consummated right law, insomni principles, having vested constitution, secured rights of immunities from taxation and from criminal and civil jurisdiction by and of Union State rights, Republic under the U.S.A. pursuant to but not limited to the United States Republic Supreme Court and the acts of the state to with. Every sovereign state, parentheses people, is bound to respect the independence of every other sovereign state, parentheses people, and the courts of one country, parentheses people. People will not sit in judgment on the acts of the government of another done within, parentheses, the same or its own territories. The present Union, state, municipal, and civil laws and codes of the land are an incorporated union of self-government established by the political powers of the General Assembly of each state of the Union and initiated at Philadelphia, Pennsylvania, North America in the year 1854. It governs only the rights and conduct of white people, and that's capital, Christians and Jews of the 1863 Union State Rights Republic under the Magna Carta Charter, the Knights of Columbus Code, and the Ku Klux Klan oath. Forever said Union State Rights Republic denied citizenship in the United States Republic, U.S.A., to descendants of Moorish national in the Western Hemisphere, erroneously referred to and branded and mislabeled as Negroes, blacks, coloreds, African Americans, etc., etc. In addition, the Supreme Court of the United States, in the landmark case of Dred Scott versus Sanford, 60 Statute U.S., that's 19 Howard 393, 1857, held that Negroes, whether held to slavery or free, were not included and were not intended to be included in the category of citizenship or citizens. Did y'all catch that? Did you catch that? Did you catch that? I had to read all of that to get to this point. Categories of citizens subject to the United States Rights Republic, resultably the true indigent nobles of the Al-Moroccan Empire. And we're going to keep going. We're going to keep going. Give me a second, because if you listen long enough, you're going to learn something. You're going to learn. You're going to learn. All right. The nobles of Al-Moroccan Empire. Yeah, we're right here. free Moors, bearers of the names, titles of Ali, El, Bey, Day, and Al are excluded from the Union States Rights Republic of the U.S.A. jurisdiction. The true nobles of the Al Moroccan Empire are sovereign, private, and self-governed. I'm going to stop right there. What you are listening to is for all those that do not have a status, a nationality. They are U.S. citizens. They have already moved the Moorish Empire's assets into a position where they are now returning back to the original status, that if you're truly sovereign, you will actually be in the possession of a certain level of asset in order for you to understand the true politics and commercial codes that are being utilized between two sovereigns. We have a problem now. See, we got a lot of individuals that don't even know they're Moors, don't care that they're Moors. They just want the credit. And it's very difficult to administer credit to such a stiff-necked people who, despite the oppressor oppressing them, they still are dependent upon their oppressor, to the point that they do not want to stand and be responsible for their portion of their inheritance. They just want to squander it. Let me explain to you what I mean by squandering your inheritance. A lot of individuals will tell me, Bazell, once I get this and once I get that, I'm going to start this business, I'm going to do this, I'm going to do that, I'm going to do this. And guess what? When they finally get the capital, a lot of them abandon ship. They abandon their plan. They do something totally different. Or they call me up 6 months later and say, Bazell, guess what? What had happened was you totally deviated from the plan in action. That doesn't show that you're competent. Or here's my favorite. You will have a plan, but the plan that consists of you following the instructions, you will deviate away from the instructions and then somehow conjure up that it's not that, oh, the process doesn't work. Wait a minute. Why doesn't it work? 1 + 1 = 2. Well, see, what had happened was, you allude to the fact that you didn't follow the instructions, but you still expect it to work. I'll go even further. A lot of individuals don't realize that this is a divine movement. This thing is spiritual. Guess what? If you don't get in line with what you're supposed to be in line with from a righteous standpoint, I don't care what you do. This may not be for you. These are all divine principles. What we're articulating in this training is that even the oppressor, they are following an order, a rule, and you are hearing what they intend on doing. They are going to tell the public whatever they need to tell them because the public is not competent. They can't handle the truth. Look, it's bad enough we're telling them that they're Moors. Hell, the Caucasians can't even tell them the truth now. Matter of fact, the Caucasians just alluded to the fact that, look, we had to put their estate back in right standings with true assets because you can't make an omelet without breaking some eggs. And I know this may be over a lot of you guys' head if you're just thinking, wait a minute, you mean to tell me I'm supposed to actually have silver if I have a mortgage? Aha. Aha. Let me say it a different way. If you have been in a mortgage for a minute and never received the reconciliation back to your estate of what was signed when you got the mortgage, a lot of you think, well, I'm supposed to be getting a refund. Yeah, a refund of assets, not a refund of debt. But guess how many people going to miss that boat? They're going to realize, just like with the anticipating loans, you go out H&R Block, Jackson Hewlett right now. You're waiting for your taxes to, to come back. So guess what? They offer you this, this loan that you can get. You don't read the fine print because it's at a 300%, 360% interest rate. So that means on a $5,000 tax return, you just gave up $1.5 million that you're supposed to be converting into gold or silver. But guess what? Most of you won't. You will go and do what I'm asking you to look into only to get the fiat. Listen to what I'm about to say. If you don't use gold and silver, you never paid for anything. You just offset it and discharged it. And some of you are comfortable just offsetting and discharging, but you can't offset and discharge without substantiating. Because if you do, this status, this black, Negro, and colored status is going to erode away your inheritance. And this is not me. I'm telling you, in order for them to protect you from yourself, they're saying, well, you're not worthy. You don't want to learn this stuff. So let's just save a little bit for the grandbabies. Because you know what? This old system's got to go. There isn't no fiat currency that has, been around, forever. All fiat fails. And the USD is no different. Why do you think mortgages, which were around before the stock market, has gone back to silver? If you do not understand HR 5404 is real, then you're going to realize that you are no longer in Kansas. Keep listening. I've read this document numerous times to different individuals, and I know a lot of my Moorish brothers and sisters, they only think about this when they have to. And this is the last thing they think about when they're in commerce. Just like I know a lot of my trustees that I'm working with, if I ask them to show me their statement of accounts that they've been operating in commerce in the last 14 days, because I know you just wasn't sitting in a room lighting a fire, you wasn't living off the land, you went out there and did commerce. And you can't substantiate. I keep trying to tell you that you're actually throwing rocks at the chain gang. I keep trying to tell you that you're dealing in contraband. I keep telling you that you're an enemy combatant against your own government. And I'm not going to keep stressing that when you got these officials that have said, well, you ain't got to figure it out. We've already figured it out. I'm going to move as the current directs. And what that means now is, I said this last week, you need to be making friends with your notary. And you need to be the most educated person in your estate planning, because you got a lot of work to do. Lucy, you got a lot of explaining to do, and you got a lot of work to do. All I'm saying is that this training is designed to expose you to a position that if you don't truly move in a certain capacity, silver-backed mortgages, you don't even fathom what that leads to. And I'm not going, I can't do that in this session anyway. It's just too long. It's just too much content to cover. But those of you that actually have access to WTDTA radio, all those that are in trustee training, we're going to get it in today. This is groundbreaking news right here. This is marching orders. Matter of fact, if you was trying to figure out, well, man, how we going to do this and how we going to do that, you just was there. I'm telling you how you're going to do it, because they've already pushed the first level of this, already out there. Look at number 12. If any tribunals find absent of proof of jurisdiction over a person or subject matter, the case must be dismissed. And that's Louisville versus Motley. See, the accuser bears the burden of proof beyond reasonable doubt. Let me give you something. And again, a lot of people don't realize that the actual Moorish science temples are embassies, and they're supposed to be holding tribunals. They're supposed, look, the Moorish science temples are supposed to be holding tribunals. Moorish science temples are supposed to be holding tribunals. I said that 3 times. Anyhow, keep listening, because if you listen long enough, you just might learn something.
change just operates on a longer cycle than that. Of course, as you suggest, as severe weather becomes more common, and that's connected to climate change, you will see those things, entering the forecast period and it's certainly entering our supervisory practices as well as our economic forecasting.
In a recent speech at the San Francisco Fed's Conference on the Economics of Climate Change, Fed Governor Leo Brainerd said, quote, "By participating more actively in climate-related research and practice, the Federal Reserve can be more effective in supporting a strong economy and a stable financial system." Do you agree with Governor Brainerd's statement? If yes, what more will the Fed do in the future to identify and mitigate the financial risks of climate change?
So I do think it's incumbent on us to do the research and understand the implications of climate change for our supervisory roles and our roles in looking after financial stability. And that's what we're doing. I think it's early days for that, but the public will expect that we do that and that we take the measures that we need to take to make sure that the financial system is resilient.
Do you agree with her statement generally?
That statement I do, yes.
Okay, thank you. Big bank mergers and market concentration. 3 months ago, the Federal Reserve approved a merger between BB&T and SunTrust, which created the 6th largest bank in the U.S. with more than $450 billion in total assets. And the Federal Reserve's own research suggests that the failure of a single $250 billion bank would be far worse for the economy than the failure of 5 separate $50 billion banks. Furthermore, the former FDIC chair, Mr. Gruenberg, has warned that the FDIC would not be able to wind down a bank the size of the combined BB&T SunTrust without imposing significant losses on the Deposit Insurance Fund and potentially destabilizing the financial system. In this light, can the Federal Reserve justify its conclusion that, quote, "this transaction would not appear to result in meaningfully greater or more concentrated risk to the stability of the financial system"?
Yes, I think we can, and I think we did. We evaluate these mergers under a very clear statutory framework, very transparently. We had a number of public hearings on it and looked at all the statutory factors. And essentially, you have two banks coming together to form a regional bank that's akin to or smaller than many of the other regional banks. And it doesn't appear to me to have significant financial stability implications at all.
Thank you, Chairman. I'll yield back, Madam Chair.
The gentleman from Tennessee, Mr. Kustoff, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Mr. Chairman, for appearing today. I heard your statements in your opening remarks about the coronavirus, and certainly in regards to some of the questions that you've had today. I noticed this morning in a report that Axios listed, they quoted from the Global Port Tracker, and it said that traffic at U.S. ports is expected to decline in February almost 13%, and in March between 9 and 10% year over year. Now, assuming that those numbers are true and correct, what impact, if any, would that have on the retail sector, and what impact, if any, would that have on the overall economy?
So I think there's a lot of uncertainty around what the ultimate economic effects will be outside of China and particularly in the United States. And the question will be, we do expect that, consistent with that report, that there would be some effects. The question really will be, what will be the size and scope of them, and also, will they be persistent, or will it be something that just passes through? And And ultimately, the bottom line question for us is, does it represent a material change in the outlook? Something that we should react to with monetary policy. That's really the question for us, and it's really too early to say. We'll be monitoring it like everyone else will, very carefully, and that's where we are.
Along those same lines, and I'm also from Axios, they quoted from a Bank of America security report. They said they surveyed 3,000 companies about the global supply chain, and that many companies around the world are looking at relocating. They called it in the report a quote-unquote tectonic shift in global supply, looking to other areas of South Asia, India, also North America. My question to you, first of all, I don't know whether you're familiar with the study, this Bank of America Securities study or report or not. Are those numbers, or is that those anecdotal statements, is it consistent with anything that the Federal Reserve is seeing?
I'm not familiar with that report and therefore can't comment on it. I would say there are a number of channels through which this could have an effect. The first of which is just tourism, really. The second is that our ability to export to China is less because it's just less going on there. So exports could go down. You mentioned really supply chain. So many U.S. companies buy intermediate goods as part of creating their final product. So supply chain issues, we don't have any real evidence on that yet. And I'd say the last channel is really financial markets, which financial markets themselves can be a channel for the transmission of risk-off behavior, which can affect economic behavior. So we'll be looking at all of that. It's way too early to say what it will amount to. We're just going to have to wait and see. There's no way to be kind of confident about anyone's assessment, and there are a range of assessments.
Based on what you just said, I think I know your answer, but I'll ask it anyway. The report it mentioned a number of reasons. One is the tariffs between our country and China and the impact that it's had on China and subsidiary companies, but also automation and the increase in automation. Does that sound consistent with relocating these supply chains?
Well, that's, yes, separate from the questions about the virus. There clearly has been, on the part of American companies, a lot of activity in moving to other jurisdictions, like Vietnam in particular gets mentioned quite a bit. I saw a report last week. A number of other countries have had American businesses moving their production activities out of China to other locations, and that certainly has happened.
Including the United States?
Yes.
Thank you. Or relocating back to the United States. I guess along those same lines, I represent part of Memphis and West Tennessee. In Memphis, just outside my district, there was an announcement Amazon made 2 or 3 weeks ago that they are locating a new facility there. It'll be 1,000 jobs, and incidentally, you had questions on the minimum wage. They're going to start their wages at least $15 an hour plus benefits. But it talked about these new jobs in combination with automation in terms of packing and shipping. You've talked about your concerns of automation and the effect that will have on employment in the future. Can you see the two coexisting, for instance, like with this Amazon plant?
Well, over the last 2.5 centuries, we've seen advancing technology, and there's been a concern that it would replace human labor, and that has happened. But what has happened, though, is it has made human labor over time more productive. So there's displacement of current workers, but over time, advancing technology has led to rising incomes. But that doesn't mean there won't be disruptions and a lot of pain for people in the short term. But nonetheless, the process over time has led to rising incomes.
The gentleman from Florida, Mr. Lawson, is recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chairman, welcome to the committee. And I would like for you to explain to me, for the past almost 3 hours, 2 hours and maybe 45 minutes, when you were talking and members on the committee was speaking in terms of how well the economy is doing, how we have more opportunity for jobs in the economy. when you started speaking, the Dow was up 125 points. And while you were speaking, it went down. Can you contribute to tell me why something like this occurs? Who is listening to your speech this morning in front of the Financial Service Committee that would cause the Dow to go down? Is this because of the cuts in interest rates? How do you explain that?
I really can't. I'm not following the market as I sit here answering your questions.
Okay, well, I know the president tweeted out something similar, that when you started off, the Dow was up and then the Dow went down. Do you react to that, or it doesn't really mean that much to you?
I'm sorry, do I?
Yeah, do you react to that, or the president tweet about also about how the Dow went down in the cutting of interest rates? Do you react to that, or it's just something that happens?
You know, my colleagues and I are completely focused on using our tools to support the American people, to support the achievement of our goals, and that's really all we're focused on.
All right, explain to me too, from the staff report, they stated that starting in July of last year, that for about 3 different times, the interest rate was cut by 0.25%. You know, how do you make decision? Did that stimulate the economy when you made those all the way through October, a 0.25% cut in the interest rate?
Yeah, so we were really looking at a few things when we did that. And yes, the intention was definitely to support the economy. Part of it was to offset the effects of global factors, and there I would say just the slowdown in growth in the global economy just went on, and we felt the need to offset that and also take out some insurance against the effect that might have on the U.S. Trade policy uncertainty was weighing on the U.S. economy. We tried to offset any potential effects and take out some insurance there. And the third reason was that we wanted to do what we could to guard against a more prolonged shortfall of inflation from our symmetric 2% objective. So we've supported growth to support inflation moving back up. So those were the reasons why we did those 3 things. And that's the thinking that we had and that we announced.
Okay. Now, could there be, I'd like for you to comment, that be a correlation between the growing student debt crisis and slowdown of the housing market, which we talked about a great deal in the last couple of months? As you know, many borrowers of student loans are not able to get homes because of the high debt to income ratio. Could there be a signal that there is a great need to address first the mounting student debt crisis?
So I would say that the rising student debt is certainly a concern. It's been rising fast and is now large. There's increasing evidence that shows that students who can't pay that, who can't service that debt, have difficulty having normal economic lives and buying homes and things like that. I haven't seen any evidence that would suggest that it's an important factor currently today driving the housing industry. I would say the housing industry has actually activity in housing has been moving up here over the course of the last 7-8 months as the effect of lower rates and just overall good labor market and things like that are showing up in more house building and also housing sales.
My time is about to expire. I have a lot of students in my district, in the 5th Congressional District, and many of them coming out of school. One of the things they're concerned about is the housing issue. You know, with going into the job market, you know, how can they best share an American dream like their parents without getting the help from their parents? And so with that, Madam Chair, I yield back.
Thank you. The chair wishes to remind members that we have a hard stop at 1 p.m. today. The gentlewoman from Massachusetts will be the final member to ask questions today. With that, the gentleman from Indiana, Mr. Hollingsworth, is recognized for 5 minutes.
Well, I appreciate the time, and I, both in private and in public, have been extremely complimentary of the work that you and your colleagues have done, not only in calibrating conditions to match the current economy, but also in the framework by which you make many of your decisions, and how you present that in public. I can really appreciate, and I know a cornerstone of what you've been trying to do at the Fed is bring even more transparency to the Fed, and some of the decision-making and the press conferences that you've had have added a lot of transparency to it. So it's hard for me to understand some of the challenges in CCAR are in the stress capital buffers, and some of the more vague language or inability to pin down timeline for changes to that, expectation of changes to that, especially when 2020 CCAR has already started. I know Ms. Wagner also asked about this. I had asked Quarles about this in December. I think I sent a letter to you and Quarles, signed by every member on this side of the aisle on financial services, just trying to get a feel for what are the changes that are going to be made, what's the timeline for those that would undertake these stress tests, getting those changes. They're trying to make decisions with trillion-dollar balance sheets, multi-billion-dollar balance sheets, trying to make their plans. This time is now upon us, and I feel like we're still being very vague about what's coming down the pike and when we can expect, even whatever that may be that's coming down the pike, when we could expect that to arrive before us. And so I wondered if you might give some more color on that, or give some reasons why you and your colleagues have been a little more hesitant to answer.
I can't give more clarity than exists, so I'll just say again, we do expect that the core of the stress capital buffer will be incorporated into the stress test this year, and we'll do that in a way that's timely for CCAR.
Okay. In our previous conversations, I think we'd had just kind of a general agreement, and don't let me overstate that if that's incorrect, that some of the aspects of this need to be calibrated, right? We put a lot of this into place post Dodd-Frank. We felt like we were doing the right thing in doing so, but perhaps we either had unintended effects, maybe the intended effects weren't as great as we thought they would be, or maybe perhaps this wasn't the area we needed to focus on, and I think we'd agreed that some of this requires significant calibration going forward. And do you expect that there will be further review and calibration of these tests to reflect either current conditions or alternatively what we've learned?
All right. What we have here is, we got a lot of individuals that's definitely getting on, a lot of streaming and buffing that's actually taking place. So we're going to just sum it up and just make sure everybody understands how the stuff is laid out. Because of what we're dealing with in this proponent, I want to now focus the attention of this segment to a couple of things that are going to be very important, and then I'm going to actually jump onto our broadcast so I can continue to give you this exclusive content, make sure everybody doesn't lose their place, their marker, and all the stuff that we're actually discussing. So let me bring your attention to a document here. And this document is designed to make sure that everybody understands that you're no longer in Kansas anymore. All right, this is actually HR 5404. And HR 5404, for those of you that have not ever seen this document before, is one of the main reasons why we're moving into this implementation stage. This actually talks about to define the dollar as a fixed weight of gold. It talks about in the House of Representatives, and this was done on March 22nd, 2018. It says Mr. Mooney, which is the West Virginia, introduced the following bill, which was referred to the Committee of Financial Services, the same committee that you're listening to right now. It says that to define the dollar as a fixed weight of gold, number one, be it enacted that the Senate, House Representatives, the United States of America, and Congress assemble. Section 1, this is their findings. Congress finds the following. Number one, the United States dollar has lost 30% of its purchasing power since 2000 and 90% of its purchasing power since the end of the gold standard in 1913. Number two, under the Federal Reserve's 2% inflation objective, the dollar loses half of its purchasing power every generation, or 35 years. Number three, American families need long-term price stability to meet their household spending needs, save money, and plan for retirement. Number four, the Federal Reserve policy of long-term inflation has made American manufacturing uncompetitive, raising the cost of the United States manufacturing goods by more than 40% since 2000, compared to less than 20% in Germany and France. Number five, between 2000 and 2010, the United States manufacturing employment shrank by 1/3 after holding steady for 30 years at nearly 20 million jobs. Number six, the American economy needs a stable dollar, fixed exchange rate, and money supply controlled by the market, not the government. Number seven, the gold standard puts control of the money supply with the manufacturers instead of the Federal Reserve. Number eight, the gold standard means legal tender defined by and convertible into certain quantities of gold. Under the gold standard through 1913, the United States economy grew at an annual average of 4%, 1/3 larger than the growth rate since then and twice the level since 2000. Number 10, the International Gold Exchange Standard from 1914 to 1971 did not provide for a United States dollar convertible into gold, and therefore helped cause the Great Depression and what? Stagflation. This is what this meeting is about, stagflation. I keep telling you, they've already telegraphed what they intend on doing. Watch this. Number 11, the Federal Reserve trickle-down policy of expanding the money supply with no demand for it has enriched the owners of financial assets but endangered the jobs and wages and savings of blue-collar workers. Why? Because the blue-collar worker don't want gold, don't want silver. They have been sold a commodity that they call silver and all this other stuff, and they have not been taught properly on their estate being eroded away. I go back to what I just read in this document here. Remember, Moors, your estate has been preserved by silver through the mortgage-backed security industry, because those of you that are Moors are going to be giving back your inheritance. It's already in play. You just got to now act in the capacity of where you fell from, because everybody else is being governed under this new standard, HR 5404. All right. The International Gold Standard from 1914 to 1971 did not provide the United States dollar convertible into gold, and therefore it helped cause the Great Depression and stagflation. The Federal Reserve trickle-down policy of expanding the money supply with no demand for it enriched the owners of the financial assets, but endangered the jobs and wages and savings of the blue-collar workers. Restoring America's middle-class prosperity requires change in the monetary policy authorized to Congress in Article 1, Section 8, Clause 5 of the Constitution. Define the dollar in terms of gold. Effective 30 months after the date of enactment. 30 months from the date of enactment. 30 months from the date of enactment. 30 months. 30 months. What's 30 months from March 22nd, 2018? What is 30 months? 30 months is 2019 is 12 months. 2020 is 24 months. So March 22nd, 2020 is 24 months. And we have, that's March, April, May, June, July, August, September. September 22nd, 2020 will be 30 months. I keep stressing, and this was done, the Committee of Financial Services, the same committee that you're listening to, talking about they've already moved into the silver-backed mortgage security proponent of this plan. I keep stressing you're not in Kansas anymore. I keep stressing the importance of CECL implementation. I keep stressing the fact that you need to do everything possible, bring as many cases as you can to arbitration. Therefore, we can really examine this with the proper filter, because you're not in Kansas anymore. I just wanted to share this with you. This is our YouTube channel. I don't like getting in the public and really put a lot of stuff out here publicly. We got a private network that we do stuff. But guess what? I'm not going to be charged with the